Hello, welcome back. Mike from Canavan Wealth. It is tax time, and there's an absolutely fantastic article that came out from the Wall Street Journal that's way too long for me to cover in Mike Reed's Journal. So I wanted to cover it today. This is about, kind of how the tax environment in the U.S. works and kind of how you'll see it's a bunch of numbers about kind of effectively how we fund the government through income tax, specifically individual income taxes, although it covers some other topics. So let's dive into it. So in the beginning, it gives you this little quiz. I'm just going to cover up the one answer that's wrong because I don't want people to look at it. I want to just focus on the good facts here. So it says most of the 180 million taxpayers will be low earners. Low, you'll see it's not that low. So saying about 70% of all people that file a return earn less than 100,000. And I believe this is per person. This is not household. So in aggregate, they will earn 30% of the income of individual U.S. taxpayers, right? So 70% of the people earning income in the U.S. earn 30% of the income. Right? I'm going to try and keep this as apolitical as possible. I'm not going to touch that. They owe or pay 1.5% of all individual income taxes that are collected, right? So 70% of the people in the United States earn about 30% of the income. If you just, those are two different big pool of people. 70% of them earn less than 100,000. And then of all the income earned, they earn 30% of that pie. And then of all the taxes collected, they contribute 1.5% of all taxes collected. Okay, so 1/4 of filers earn between 100 and 500,000. So now this is a quarter, so 25%. So these two groups together make up 95% of all the people who are filing tax returns in the U.S. And they receive about half the income. So now if you add the two groups together, these two groups earn 80% of all income received in the US, and they owe about half of the income taxes, right? So now 51.2%, right? So this group, which is a very diverse group, earning between 100,000 and 500,000, they earn about half of the income, and they also pay about half of all income taxes collected. And this last group, we're going to skip a group from 500 to a million. This is just going to jump to people earning over $1 million, which is about 900,000 filers. They earn 16% of the total income earned. Of course, they're a very small group by percentage-wise. This is like 0.3%. There's about a million. There's about 360 million people in the U.S., I believe. And they pay 40% of all income taxes that are collected comes from this group. They earn 16% of total income, but remember, there's a lot less of them, right, when it comes to it. So you may think like, oh, well, they only earn 16% of the income earned in the U.S. Yeah, but that is being divided by a very small denominator in terms of actual number of people, about 900,000. So this talks about that being correct. This next chart is really, really neat, I think. This shows where revenue comes from in the United States. So individual income tax makes up 54% of the revenue that the US government makes. 30% is effectively FICA taxes, Social Security, and Medicare. So these two together, most people see these as the same thing, which means 84% of the US tax revenue comes from your paycheck or your business or whatever it is. Corporations pay 8.2%. Now, remember, they also, right, they have employees that make it, but this is the actual corporation. So you have to kind of understand how corporations work in terms of like maintaining, cash. But I'm sure people have a lot of opinions about this. Other revenue, obviously, this is just like a bunch of little things at 5%. Excise taxes, this is import-export stuff, 1.8%. This surprises me. Estate tax is 0.6%. How little of an impact estate taxes have on our revenue as a country. All right, I've got a slide here to make sure I stay on track. So we looked at the numbers. Okay, so why do we have a progressive tax system? Obviously we do. Right? It's going to show it right here. So this is This gray is share of total income. So this is what percentage of the income in this earning bracket this group earns. And then the blue is how much income tax they paid. Now, this does not include Social Security and Medicare, which is effectively, it's certainly not a flat tax. Well, it is a flat tax, right? You pay a percentage of that no matter what. This first group, people earning less than 50,000. Oh, and by the way, these earning numbers are adjusted gross income, AGI. So this is kind of like what your taxable income is. Not exactly. There's other numbers, but I'm not going to go into the tax code because I'm not a CPA and it will make this video very boring. But so this group has a negative tax contribution because of things like the child tax credit and earned income credit, which is effectively a way that Congress and everyone has found ways to help out people in this bracket. They actually receive more money back than they ever paid into the system. Of course, remember that they're not including Social Security and Medicare in that. That turns positive if you include those. Then these next group, right? So you can see that the blue line starts catching up with the gray line, meaning that the more and more you earn, the more and more taxes by percentage of your income that you pay. This is called a progressive tax. This is how, to be perfectly honest, most tax systems in the world work. And why do we have it that way? Lots of reasons. If you want my opinion, this is 100% my opinion why we have a progressive tax, and why I agree with a progressive tax is that when you are at the highest earning, that's typically because you have some type of a business, right? Working for someone else, you're often not it's going to be tough to break into these really high numbers as a normal employee for someone else. You're typically going to have a business, or you're going to be running a major corporation business, right? You're going to be at the high levels of executives in major businesses, or you're going to run your own business. And they disproportionately are benefited by the modern society we have because their business sells to this modern society and uses the employees of this modern society to run their business. So does everyone benefit from streets and public transportation and all of this? Absolutely, they do. However, people who run and build businesses, in my opinion, disproportionately benefit from it because it's back to that exact society that they're selling all their goods and services. So that's why I don't have a problem with the progressive tax system, and why ultimately I think it is a good deal. Let's go down. Okay, we're going to jump back to this long-term taxable gain. Okay, so what is the damage of taxing the middle and taxing the bottom? So kind of going back to this progressive tax system, let's start with the bottom, actually, even though I put them in the wrong order, which is this group right here. 180 million taxpayers, 70% of those earners earning less than 100,000, and they pay 1.5% of the income taxes. I think the best way to look at that is if you literally doubled the amount of taxes that the people in this group paid, I'm not going to call it a negligible impact on federal income, but it is very little, right? If we were going to try and pay for major programs by taxing this group of people, we would have to triple, quadruple, right, 5x the amount of taxes that they pay. And this would have a dramatic impact on these people, right? These people, almost, a large percentage of Americans, if we, let's say, tripled the amount of taxes that they paid, it would go right to their bottom line. It would have a massive impact, negative impact on the economy. They would stop spending money because they would be paying it all in taxes, right? So if you think like, it's not a whether it's fair or not, in my opinion, it's a fact of a progressive system that it is just not very beneficial to try and overtax the lowest of earners, because you can't get water from a stone kind of standpoint. And it would be a negative impact to the rest of us that run businesses to have all of those people have less money to spend on our businesses, right? So then what is the bad thing about taxing the middle part? And just for kind of transparency, this is kind of where I fall in the progressive tax world. It's in this, 1/4 of filers that earn half the income and pay half the income taxes. I'm going to go this back. I used to have fairly good access to a very smart business person who built numerous businesses throughout his life. And he gave me lots and lots of good advice through that, which I hope that I have capitalized on. But he explained to me why the way our tax system hurts this group of people. And this is me not saying that we should do it differently. I'm just saying this is the fact of why it hurts this group of people and why it hurts the American economy. But I don't have a better solution for you. And my solution is not like we should just tax people who have more money than I have, but it's this. There is a point when you are building a business in America where you get to a point, usually somewhere in this income stream, where what you pay in taxes runs afoul of how much work you need to put in to continue to grow your business. And it's also at this point where you have to start having a substantial amount of employees, which bring risk and cost. I think it's very important for people to understand that the cost of employee is nowhere near what their salary is. Their salary is just a very small portion of what it costs to have an employee in the United States. There's just additional taxes, unemployment, and then benefits, right? And I think we should have all those things for all employees. So, but their employees are expensive. They bring a lot of cost and risk to a business owner who is now turning over control of, kind of what they've been doing to employees, which I think is great. And you run into a wall where a lot of people simply make the decision that it's just not worth it growing past this point. I'm going to have to put in a lot more work to continue growing. I've taken a whole bunch of risks by having lots of more employees and people involved in my business. And the fact that I am now at the highest tax rates means I see very little increase to the amount of money that I get out of the business. Or I'm speaking, as just your random person in this tax category who is building a business. And that absolutely has a detrimental effect on growing businesses from I've got a couple of employees to I am a major business and a major employer in the area, which definitely does hinder economic growth. I'm not saying it should be different. I'm just saying it is one of the major things that this whole thing where 50% of the people who earning, the 25% of the people earning 50% of the income pay 50% of the taxes. The progressive tax system, if you want to make the argument about why it should not get more progressive, that is the argument you make. It absolutely does discourage people from building businesses past a certain size. And that size is when you would start to employ lots of people, which is good for the economy. Okay. Again, not making an argument that we should not have a progressive tax system or anything along those lines. I fully believe in a progressive tax system, but I think people should be aware of that. All right, let's talk about long-term capital gains because that's what the last of this article is about. So this, at the top, we are largely talking about income from work, W-2s, 1099s, right? A company paying you to do work, or you own a company and make your own income. Now let's start talking about long-term capital gains because this is where a lot of shocking information here to me. Of all capital gains, 70% of capital gains, which is largely buying and selling stock or property or some type of, there's a material thing that you bought and sold and you made a profit on it and you get capital gains from that. Stock is the most likely one. For filers earning over $1 million, they account for 70% of long-term capital gains. That's nuts. This is a very small percentage of the population, and they account for 70% of long-term capital gains. $954 billion in long-term capital gains, which is taxed at 20%, not the max tax rate of 37% here. Some states have capital gain taxes, not many. California, I don't know about New York. There's plenty of weird states that have, capital gains. If you're playing capital gains in the state, don't freak out, And so what surprises me is that this group is probably very stratified in terms of people and how they're being compensated in order for this disproportionate amount, right? Because if you are paid largely in stock, like many corporate executives are, or you own a company and you're cashing in on the growth of the shares of its stock in some way, you're not taking it as income, you're basing your income on long-term capital gains, you're paying a substantially lower tax rate than other people in this tier that are receiving it as income or 1099 income, right? So just two different ways of earning income in the world. That is, they start to talk about proposed changes, specifically Biden's kind of plan here about long-term capital gains and effectively raising long-term capital gains taxes above a certain level to make this closer, these two numbers get closer, so that people in this category, if you're receiving your income through long-term capital gains versus actual income, you're paying substantially different rates, right? And remember, this is a stone that if we can't get water out of when we squeak it more, because it pays 40% of total income taxes. I doubt that would really impact this group of people. It's going to, I mean, 70% of capital gains come from people earning over $1 million. This is substantial. Let me just quick check back here. Yes, just step up rules. So the other thing about capital gains, which again, this is going to affect everyone in those top two groups of people, though, is the step up rule for capital gains. So if you're unfamiliar, if you have, let's say you bought a stock when you were 40 for about $10,000 in it, and you hold that until you're 80 and it's worth, let's say, $50,000, you would normally owe taxes on the 40,000 that it grew. But if you die and pass it to your wife, the capital gains reset. The new owner of it owes nothing, and her cost basis now becomes 50,000. Similarly, if you leave it to your kids, the stock cost basis steps up. This is like, I'm not going to call it a hole in the tax system because it's very well intended to work this way. It's a dramatic way for people with substantial wealth to avoid capital gains taxes. Just the truth of it. So, effectively, the administration's proposal is to try and close this gap and raise the tax on long-term capital gains, specifically for people that earn over a certain amount. This is interesting. This will have a really negative impact on my industry specifically and many of my clients. I can't say that I think it's a bad idea. It continues to make the tax system much more progressive. I think it moves to make things more fair in this upper tax wealth strategy. This is a lot of the reason why executives are paid in stock, because they don't get paid. They don't pay income tax rates on it. They pay long-term capital gains as long as they hold it on for a week or for a year. So, really, really interesting, right? This is not meant to be a bash on our tax system or try and imply that one group pays more than another and shouldn't or should pay more. It's just, I think a lot of people I didn't know a lot of this, so I think it's very valuable for a lot of people to understand where they fall out in the tax world. And so that when they hear something on news about something that's going to change with taxes, that they really understand who that's going to affect and how effective it might be. One last thing I do want to say is, like, when you look at these, this is a big reason why you should understand the difference between things like tax credits and changes in tax percentages. Tax credits are typically dollar values, and thus they disproportionately affect this group of people, lower earners, because it's often dollars per person, which has a huge impact on their taxes, which I often like, because this is the group that we want to be strong consumers so that they can buy goods and services from the business people. And percentage-wise disproportionately affects the top group of people, right? Because percentages of their income is a substantial dollar value compared to $300 or whatever it is for a child tax credit or something along those lines. Okay, that we'll draw it to a conclusion there. If you like content like this, want to see more, by all means, subscribe to content. Webinar just next week, and May's webinar is going to be on Social Security. All right, I hope this has been informative. I will talk to you soon. Thank you.